Candle range theory, CRT. Is it really the holy grail and is it something new? This is what I'll answer in this video. I'll go over what is CRT, the reality of it based on my experience, when is it a high probability and when is it a low probability, and a new and better approach to trade it. Make sure to like, subscribe, share this video with your friends. Let's get into it. Now, the first thing, I'm here in this video, I'm not here to explain what is a candle range theory because, I mean, obviously, even 8 years old kid knows that a candle is a range. So there's no need to sell courses and get thousands of dollars from people just to sell this information that a candle is a range, which is being known for people for a long time. What I'm trying to do in this video is show you when this work and when it doesn't work, because obviously a lot of people say that this is an objective approach to the market when in reality it's not really, right? So not every time this is gonna be a valid range, and even the reasons that they're giving that, oh, you look for this specific candle or this one, it still doesn't work. Again, if you are someone who has been following me, or not even following me, but you've been trading for, let's say, minimum 3 months, you know that a candle is a range. We've been saying this for a long time. Market is fractal, right? Whatever works on the 15-minute will work on the 1 minute. What does that mean? A 15-minute is nothing but what? A price action on the 1 minute that is part of the 15-minute. So it's the same thing here. What we're seeing is what? A candle on a higher time frame and then range on the lower time frame. And this has been known for everyone, right? This is a common sense, not even, it should not be called as a theory. So I'm not here telling you that, oh, this is the holy grail. It's nothing near that. You use this as a confluence, a candle high and low, and we've been using this. And one of my first strategies that I published in the channel was about the 4-hour sweep, right? And what we use is 4-hour high and low. So that was one of the strategies that I actually published almost a year ago, right? So this is nothing new. Now, what is that? Very quickly, let's say in 20 seconds, right? Let's go. A 4-hour candle, for example, has a price action or structure on the lower time frame on the, let's say, 5 minutes. This structure will create the low of the candle and the high of the candle. When you switch from 4 hour to 5 minutes, you'll see a range. When you do the opposite and switch from 5 minutes to 4 hour, you're gonna see all of this price action as a one candle. It's just telling you that a candle is nothing but a range on the low time frame, and that's common sense. So I hope you really know this before actually me going over it. Otherwise, you've been trading for, I would say, less than a month or less than 2 months, okay? Because this is common sense, and this is even before you learn anything about trend lines, about indicators. This is what you know. When you're using TradingView, switching between time frames and learning for the first time, you will definitely notice this, even without anyone telling you. Because if I create a course based on this, it's gonna be embarrassing to me. Let's say you trade previous day high and low for some time. So, you know, your strategy is based on what? Previous day high and previous day low. When taken, you go to the other direction. What is this? It's nothing but the same. So we have previous day high, for example, or let's say this candle, which has a previous day high, previous day low. And what is this? Euro USD daily chart. So what do we see here? Previous day high right here, previous day low. What happened is price taking the previous day high, not closing above it. Now we can look for previous day low. So we know that this is a range. It's a common sense. We took the high, we're going to the low. The same thing happening here. We took the low of the previous day, we go for the high. If you've been trading previous day high or previous day low, then you're basically trading what? Candle range theory. And it doesn't need to be in a fancy name because that's common sense. Now, again, the same thing here. What we have is, let's say right here, sweep, go into the high, and it happened here. Sweep, go into the low. So trading previous day high or low that people have been trading for a long time now, for years and tens of years, it's the same as candle range theory, but no one needed to call it new names. Okay, so that's the thing. Now, this is not gonna be valid all the time. That's one thing. Now, talking about accumulation, manipulation, and distribution and how it is related to the candle range theory or the candle's previous high and low, right? Now, when looking at this candle and what I'm talking about here, you know, the completion of the AMD is price reaching the major drawn liquidity. So let's agree that this is a bullish candle, right? So bullish candle here, and this is a bearish candle. As you see, bullish candle, bearish candle. Now, what happened here in this candle, just candle by itself, right? Price actually opened here. So open here, manipulation below the opening price. So inside of this range, already we had a manipulation, and let's say we had a major liquidity that is right here, right? So this is the major drawing liquidity. What happened is manipulation and then distribution going where? We did not stop here, but we actually went to the main drawing liquidity. So that's accumulation, manipulation, distribution in one singular candle. That's the first type that we need to understand. So we could have AMD, and that's when CRT is not going to work on the next candle because we already had a major drawn liquidity hit and a major AMD happening on one singular candle. We got to understand this. Now, there are times where it's not going to be on one candle. It's going to be in two candles, the same as you see it here. So you see, we're going up. We had a main drawn liquidity that is here, and we did not reach it, right? So it was not reached, and we created a liquidity here. This is a bullish candle. We closed here. What happened here is that we actually, and we were going against the drawn liquidity, right? We're going up while the drawn liquidity was not reached, and we did not, complete this market maker's model, for example. So what happened after is price opening here, maybe accumulation, manipulation above the opening price right here, and then distribution. But where did we stop? All the way to the main drawn liquidity. So that's a power 3 or AMD in 2 candles. We could also have power 3 in 3 candles, which is like this. So let's say we have a main drawn liquidity that is right here. And what happened is this candle going bullish, then sweeping this high of a candle and only closing here. This tells me that we're going to have a continuation to the lower side. So we already had the manipulation. Candle closes here. Distribution is going to be followed by this candle here. But most of the time, we're going to have another manipulation. But this one is a minor one, right? So this manipulation, it's not going to go and take this high. It's going to only be a manipulation here, a minor one to get some liquidity and go lower to this. So we have 3 tabs of accumulation, manipulation, distribution, or power 3 in 1 candle, 2 candle, or 3 candle. It all depends on the situation that we're dealing with. What are times that the CRT or the candle range theory is going to be actually a high probability one? A lot of situations. That's what we're going to cover on the next slide. But for now, we're going to focus on one thing and one thing only. The POI, the relationship between a CRT and a POI. In order to get the best results with this theory, or I don't want to call it theory, but just for the sake of this video and for the sake of delivering the idea in the best way. The best way to use the candle's higher low that you need to deal inside of a POI or near a POI. And that's the major difference here. So if we have, let's say, prices going lower, the same as here, prices going lower. And if you notice, sometimes I have different colors of candles because this is another slide. But this one here is a bearish one. This one is a bullish one in this specific slide. So we're going lower. We had, let's say this is a 4 hour, right? 4 hour. So 4 hour closes bearish inside of a POI. You see right here in this wick, there are a lot of people who entered long already. Most of the time, if we don't close above the POI and this is out of kill zone, what's gonna happen is this is not gonna be a valid lower time frame entry because it's out of kill zone. What's gonna happen is price opening here, maybe going up a little bit to induce more people, going lower, manipulation sweeping previous candle low inside of the POI. If the POI is bullish, I'm gonna be looking for the low to be taken and then going up. And this candle, which is the one inside of kill zone, which is the one that is more important, and I'm gonna give you the timings of those candles. This one right here is gonna go up and we reach the drawing liquidity here on the next candle. So I had a manipulation, distribution of the next candle, and reaching the drawn liquidity. The main drawn liquidity is this one. That's the first one. The main one could be anywhere in here, right? So that's the first situation, is when we have a candle low in a POI that is out of kill zone, we look for that one to be taken. Now there's another one also related to a POI. So it's always about a POI because you cannot trade the CRT randomly in any zone. You gotta focus on POIs. So what happened here is what? Low, closed below, and we have a low here. So price did not actually reach the POI, and most likely this is again out of kill zone. So not in kill zone, not 2 to 5 and not 7 to 10. So it's out of those timings, right? It's out of those timings. So we created the low of the candle here and it did not reach the POI. What's gonna happen is price opening here in kill zone. We're gonna go and reach the POI by sweeping the low, then going higher and distributing up. Two situations here. The first one is price already inside of the POI. The other one is price very close to the POI. And this one is the real inducement here. Why? Because if we look at this from another perspective, so let's say something like this, what's going to happen is we have a POI here, right? So this is our main POI. Price is going lower, 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 and we came very close to the POI, and then we broke structure, came lower, going up. What do we see? Very simply that we have an inducement and a POI. And we talked a lot about inducement. What's going to happen is anything in here is invalid, anything in here is invalid. What's going to happen is price come here, go up a little bit, induce more people, use all of those as inducement, going lower to the main POI, going up. So this is going to be a 4-hour low on the lower time frame. And then we started going up. And that's the manipulation in the 4-hour candle, a new 4-hour candle going up. On the higher time frame, it's going to be only something like this. Another 4 hours sweeping the previous candle low, right? That's all. On the lower time frame, that's how it looks. Those are the two scenarios that you really need to focus on. And we're gonna actually go over some important candles. So candles that you need to actually focus on. So important candles include, and this is where the probability of the CRT goes up, trading those candles. First of all, the daily candles. So if you're someone who likes to enter trade sometime, enter and exit on the same day, then you want to deal with daily candles. What you need to understand though is if you have a bullish POI, so you have a daily candle and you have a bullish POI, then you look for the sweep of the low. So you have a daily candle low, right? And you're in a bullish, you wait for this low to be swept in order to go higher, because that's the fuel of the market right here. In a bearish POI, on the other hand, what we're going to look for is a sweep of a high. Now, the same logic we can apply on 4-hour candles, and we want to look for 4-hour candles that are important. And what are they? The 1 a.m. candle, the sweep of the higher low, that is going to be very major, and also the 5 a.m. And why? Because those are in kill zone. So you see kill zone candles, but on the 4-hour, those are the kill zone candles. You could also trade the 9 a.m. candle if you are in indices, right? Now, you could also trade what? Kill zone candles. So in the lower time frame, if you have, let's say, 15-minute candle, you could trade that one as long as it is in kill zone, but also it needs to be in a POI. So remember that, POI and in a kill zone. So all of the rules that we mentioned for the daily, it applies for the 4-hour and the kill zone candles on the lower time frame. So kill zone candles, I mean just lower time frame candles. We could also look for the weekly and monthly. This is gonna be a really significant level of liquidity, right? Previous weekly high, previous weekly low, and then previous monthly high and previous monthly low. Now into how to trade the CRT, right? So remember, CRT is nothing but what? A confluence. It's not a whole strategy. It's a confluence. It's something that we look for in order to execute later. So you see, we had 4-hour candle, for example, when switching to 15 minutes or 5 minutes. And then I see that, okay, we actually on the 15-minute swept a high, a major one, then created a liquidity, a fair value gap. We go back to that fair value gap to start to go lower. When you see this as a 4-hour candle happening at a specific time, then that's a good confluence to trade off. As I said, when we're in a bullish POI and we have a candle that is either 1 a.m. candle or 5 a.m. and sometimes you could use the 21 candle. Why? Because this one actually has part of the Asian session, right? So part of the Asian session is inside of this 21 candle. But take a look at this. What we had here is a bullish fair value gap and then also an order block below it. What happened is price actually creating this 1 a.m. candle inside of the 4-hour POI. What happened is we swept this one and we started going higher. And then we swept also the 5 a.m. candle and then the real move happened, right? So we don't know when it's going to happen for real. Sometimes it's going to happen at the 5 a.m. candle, sometime just immediately at the 1 a.m. candle, and sometime at the 9 a.m. candle, because that's when, especially when there is high impact news on New York. If we look here to this fair value gap, we have a bullish fair value gap and cause a breakout structure right here. Price at 1 a.m. was going all the way low and it created a bearish candle inside of a POI with a low. What I expect for the next candle is to sweep the low and go higher. And that's what happened at what time? 5 a.m. So what you could do is go here, look at the 15 minutes, look for a fair value gap and use this as a confluence, because now you have what? A market maker's model all the way to this high. It happened all the time. Sometimes you see 21 inside of this range. We have a range that goes a breakout structure, right? And price came back to it. 21 swept, started going higher. That's not going to be 1 a.m. all the time or 9 a.m. all the time. So it's all about probabilities, right? There's nothing that is guaranteed to happen all the time. We have this bearish EVG. Price came to that bearish EVG at what time? 1 a.m. But then what happened is price sweeping the high, literally a sniper entry at 5 a.m. to go lower. Now the same thing happening when? See right here, we had this bearish fair value gap, and the same thing. Price came to the fair value gap what time? 5 a.m. 9 a.m. swept and started going lower. So you could have gotten all this profit. The importance of POI aligning with time, that's how you get those really good entries, and that's when this so-called theory works actually. Now this also applicable on the daily time frame, right? And it's more accurate here because we have a really significant pool of liquidity, which is a previous daily high or low. Now take a look at here. We had this fair value gap here on the daily time frame. What happened is we had, this is a previous day high, and we are simply creating a fair value gap above. That's one trade. Could have traded this one. Now price back into that inside of the point of interest already. What happened is we swept the high and we started going lower again. You see, that's another entry. Now the same thing, the creation of an EVG offers you one entry, and the low inside of the EVG offers you another entry. So you see the same thing here, one entry here, another entry here. Now you could do the same. I mean, not even about fair value gaps. You could look at what? Those sweeps. So we had a sweep of liquidity. We're still below. We wanted to push higher, but we wait for the next day to generate some liquidity. Take it here. This is the engineered liquidity taken later in order to push higher. And it happens all the time. And the same thing here. The first setup here is the creation of an EVG. So we created EVG here. The high that created the EVG, or the third candle high, is the first one. That's one trade. The second trade is the high that is already in the EVG, which is right here. That's another trade. And then the same thing happening here. You see, another trade. It kept happening over and over in different times. The same situation here. The first trade where? The first trade is the third candle high. That caused the fair value gap being taken, which is right here. Then this high being taken, and finally this high being taken until price goes lower. And you could confirm when this is going to happen. First of all, using the 3-drive pattern. Second of all is using SMT here, right? And this happened all the time. So you see what is happening here? We have this bullish EVG, and what happened is price came back to this and gave it's a bearish candle, having a low here, swept the low, started going higher. So that's what we're trying to trade. What we also have here is a bullish fair value gap, and then that's a big one. So we're gonna have another overlapping, right? Which is, for example, this overlapping and also this overlapping here. And I've talked about this many times already. What happened here is we're not gonna trade all of this. We're gonna be focusing on the overlapping and the fair value gap, because that's a big fair value gap, and we might look for a bigger retracement. So you see, sweep into the POI. That's a valid one. You got profits here. Now another POI is here. Sweep of this low inside the POI. That's the valid entry, and we started going there. Those are the two types that I show you right at the beginning of the video. Now, I have a new approach that I've been teaching for a long time. You know, I was teaching this on the mentorship, and I was also teaching this on Discord for free and on YouTube. There's a video about the 4-hour sweep, but we're not looking for any sweep. What we're looking for is a fractal. So you see, there are a lot of times where CRT doesn't work. What to do with those? We got to take another approach. So another approach that is very helpful to you is going to be enabling fractals. So you could just go to indicators and look for fractals. This is a period of 2. This is a fractal high, or let's start from here. This is a fractal low, and that's a fractal high. What does this give me? A range. So this could be a range on the daily time frame, but I could identify it on a very mechanical way, and it's really got a very high probability of working. I'm gonna take this to the right, and you see we took the fractal box, right? The fractal liquidity box, taking the high, started to go lower. I could also apply this on what? We have this high and we have this low of the box. We have a new liquidity box. And what happened is price actually taking the high, started to go lower to very close to the low, right? That's because of SMT probably on another correlated pair. You see, we could have applied this anytime, and you're going to see that it's a very high probability, and you could go simply to a lower time frame and look for an entry. Now the same thing happening here. So you see we have this high and we also got this low. Taking the low here, immediately going and taking the high. And what you could have done here is simply go to 15-minute, look for an entry, or 5 minutes, 15-minute or 5 minute, look for an entry there after taking this fractal low. Now another example is this one. So we got this high and we got this low. That's the major liquidity level that you see. Now we have another high, fractal high that is created here, but this one is higher. And all of this is inside without creating a new low, fractal low, right? So I could not ignore this and take this high right here. I'm gonna take the main one and ignore anything that is inside. And you see what happened here is price actually doing what? Taking the high, started to go lower, taking the low. So you see, we could have capitalized on taking this high. So you see on the 50 minutes, we have this range here, and we have this fractal high on the 4-hour, fractal low on the 4-hour, and we have a big range here. We're only focusing on this. We're not focusing on any 4-hour candles that are inside, because those are the ones that are going to give me the low probability conditions, right? And what you see here is price actually sweeping that, giving a market structure shift. We have two fair value gaps, this one right here, as well as this one. Now, it depends on your setup, but most likely you want to take this one in this case. And why? Because first of all, it overlaps with a breaker block. Second of all, there is a breakaway gap here, which is not filled most of the time. So breakaway gap remain unfilled. So not really trying to trade this one. We can't trade this one. We have an inducement also here. So could have shorted this fair value gap here. Stop loss just above this breakaway gap because it's not supposed to actually be filled, right? And we could have targeted what? The low of the range, just like this. And this is what happened here. Price actually came to that gap here, started pushing lower, and there was some high impact news here. You could have applied this on 50-minute or 5 minutes, the same logic behind the fractal liquidity, right? So it happens all the time. I could go anywhere and show you an example. What we have here, for example, is this range. What happened is we took the high and then immediately go to the low. And you could have also executed in this. And this is a high probability one. Why? Because it was happening into a fair value gap. So you see fair value gap here, price swept this fractal liquidity, which is between a fractal high and a fractal low. This is a range. It could be, you know, a specific candle on the higher time frame. But what we had is a sweep of liquidity into that fractal liquidity level. We're looking at this on the 15 minutes. What we have is this fair value gap above, right, where the sweep happened. We have this fractal box right here. We swept, and what do you see here is, okay, there was no creation of a fair value gap except here. But what happened is you could have executed on this one, and I got profit here. So plus above the high, it would secure that low to be taken. But there's also another entry right here, which is what? The inversion fair value gap. You could have waited for price to come back to it or execute it on this candle by itself. So this candle here, or entering on the fair value gap, stop loss above the high, and then targeting what? The fractal liquidity low. As a 41, there you go. It's hit right here. Now, at the end of this video, just to remember that CRT is nothing but a confluence to enter your trades. Use it as a framework, nothing else. It's not the holy grail. It's not something that is going to make you millions of dollars.